In early 2026, the global financial system was running like a perfectly oiled machine. Volatility was practically non-existent, and inflation, the great terror of the post-pandemic years, seemed to have finally cooled down. The market's confidence rested on a single, widely accepted forecast. The Federal Reserve was scheduled to execute up to 3 interest rate cuts by the end of the year. Investors were buying up equities, building a bubbly, highly confident foundation for the stock market. Beneath that smooth surface, fractures were already forming. We were sitting in a K-shaped economy, a scenario where the wealthiest segments continue to grow, while the middle and lower classes see their financial health decline. Middle-income consumers were feeling the pressure of high prices, and rate-sensitive sectors like housing were quietly stagnating. The market was priced for absolute perfection, but that left a razor-thin margin for error. Out of sight, the system was straining under the weight of massive structural debts and the looming threat of higher global tariffs. Then came March 2026. Over the course of a few days, a simultaneous convergence of geopolitical explosions shattered that fragile equilibrium. Market participants quickly labeled it the triple macro shock week. Kinetic warfare erupted in the Middle East. Specifically, military actions threatened the Strait of Hormuz, a narrow, critical choke point that handles 20% of the world's entire crude oil supply. At the exact same time, the U.S. launched a decisive military intervention in Venezuela, severely disrupting another major node of the global energy supply chain. This chart shows the immediate, violent market reaction. Crude oil prices, which had been resting comfortably near $60 a barrel, violently spiked, tearing past the $100 mark and peaking at over $116 a barrel. Foreign policy crises had instantly morphed into an economic earthquake. Cheap energy is the bedrock of low prices, and with oil soaring, the threat of runaway, systemic inflation was suddenly back on the table. To quantify the severity of a sudden spike in crude oil, we have to look back at the energy crises of the 1970s. In 1973, the OPEC embargo abruptly cut the global oil supply by roughly 5%. That single constraint quadrupled oil prices, causing severe gas shortages, forcing rationing, and paralyzing consumer behavior across the United States. 6 years later, the 1979 Iranian Revolution completely halted the country's oil exports, stripping 5 million barrels a day from the market. It proved that geopolitical shocks in the Middle East inherently cripple global supply chains. The macroeconomic mechanism here is brutally simple. When the price of oil soars, the cost to manufacture, ship, and produce virtually all other physical goods immediately follows. Sudden energy shocks act as an accelerant. They are the fastest, most uncontrollable way to inject systemic inflation into an already vulnerable economy. This sudden inflationary threat handed the Federal Reserve, the European Central Bank, and the Bank of England an impossible choice. Central banks operate under conflicting mandates. They needed to cut interest rates to stimulate slowing job growth, but lowering the cost of borrowing during a massive oil shock would stimulate demand and cause inflation to explode. In March 2026, the FOMC, the Federal Open Market Committee, which is the branch of the Fed responsible for directing monetary policy, made their choice. They trapped themselves in a hawkish hold, officially keeping rates highly restrictive at a range of 3.5 to 3.75%. Across the Atlantic, the European Central Bank adopted the exact same stance. They kept their rates unchanged as they were forced to revise their own 2026 inflation forecasts aggressively upward due to the war. The mechanical effect on financial markets was instantaneous. The multiple rate cuts that investors had banked on for 2026 were rapidly priced out of the market in real time. To fight inflation triggered by a foreign war, central banks had to intentionally inflict the pain of high borrowing costs on their own citizens. The sudden realization of prolonged high interest rates, a hawkish repricing, triggered a brutal consequence for global equities. Markets gapped down heavily at the opening bell. This chart shows the technical damage on the Dow Jones. It painted a 3 black crows formation, 3 consecutive red candles signaling heavy selling pressure. Beneath the surface, traditional index correlations collapsed into scattered, idiosyncratic moves. Rate-sensitive sectors plummeted. The monolithic, highly correlated stock market of the past decade was dead. In its place stood a ruthless, K-shaped divergence where only a select few companies could survive the pressure. Yet, amidst the broader market crash, a counter-narrative emerged. Specific sectors were actively defying gravity and hitting record highs. Sovereign AI companies surged as institutional capital fled the broader market. Investors poured money into critical national security and productivity assets, seeking safe havens. Simultaneously, defense contractors and military tech firms absorbed massive inflows, directly benefiting from kinetic warfare and the rapid acceleration of a new global arms race. The post-Cold War age of easy money and seamless globalization is over. Today, geopolitical shocks dictate our financial reality, demanding a highly active, defense-oriented approach to investing and to survival.